All right, so today I wanted to make this video on diversification, right? This is Brian Feroldi. A diversified portfolio can outperform or underperform. A concentrated portfolio can underperform or outperform. There's no right or wrong way to do it. There's only a right way for you. Now, this is one of the age-old debates in investing, and my personal opinion is yes, absolutely. I think you should be diversified. But I think that there's also, to a limited degree, right? I think that, frankly, when you're younger, I think you need to be taking risks. My position has always been absolutely you should be diversified to a degree, but I also think that it's okay to have one or two positions make up, 20, 25, 30% of your portfolio if you have very, very high conviction in that. I think that, Bitcoin is an example of that, right? Maybe even higher, right? Maybe even higher. But again, that's just my opinion, right? Because again, when you're younger, if you hit a home run, you are set for life, right? If you dump $10,000 into something that, 20, 30x, right? That's $200,000, $300,000, right? Even if you keep up with the market with everything else, you're going to be well into the millions of dollars, right? So that is my strategy, right? That I have a small handful of positions that I have very high conviction in. And if I'm right, I'm set. If I'm wrong, I'm concentrated enough in the bottom, the rest, that I think I'll be fine, right? That's just my opinion, right? If you look at a lot of the most rich people on earth, Elon Musk would not be Elon Musk if it wasn't for Tesla, right? The richest people, typically, all their net worth comes from being at the top of one company, right? Even if you take Berkshire Hathaway, right? I don't know what the exact number is, but it's well more than any typical advisor would recommend, their position in Apple, right? So that's something to keep in mind, that typically, if you look at the most successful investors, typically they do break a lot of traditional rules, right? If you look at the intelligent investor, right, a lot of the recommendations in there, you would not be able to invest nowadays based on those, recommendations, right? Even Buffett broke a lot of his old rules, right? So again, I think that there's a time and a place for everything. And again, it is clearly very subjective, right? If you look at a lot of these investors, again, Michael Burry, again, talked about him recently. Again, if it wasn't for him being right about the 2008 housing market crash, no one would know who he is right now, and he wouldn't be anywhere nearly as wealthy as he is, right? So again, if you look at a lot of these top investors, typically they are where they are because of a very small amount of wins. And again, it's the Pareto principle, right? That, 20%, the good way of putting it is that if you have, 100 employees, the square root will produce half the value, right? So again, if you have 100 employees, 10 of them will produce half the value, right? Again, if you have 100 positions, 10 of them will produce half your return. So my point is you want to make sure that those 10 positions maximize that upside, because if those 10 positions are only a little bit better, you want to make sure that they are absolute home runs, right? And again, that's why I like Bitcoin, and that's why some of the other stocks that I've talked about before. I think that's what you want, right? Again, a lot of people are more safe. And again, I think that there's a time and a place for being safe too. But again, a lot of people, they don't really understand the concept of risk. Because younger people, there's a lot of people out there that their idea of risk is, I'm going to go buy NFTs and I'm going to buy these stocks that are losing money and all this stuff. Like super high valuations. Again, you want to take calculated risk. I'm not saying you be stupid, because again, I think that there's a lot of risks that people take that are really, really stupid, right? Really, really stupid. And that's a very important point, right? I think, like I say, buying NFTs, buying these random cryptos, buying these stocks that are losing money, or have crazy high valuations. Again, you are literally playing Russian roulette with your money when it comes to that kind of stuff, right? But again, a company that has a good track record, they're making money, they have good management, strong profitability, strong returns, and yet they're very cheap and the outlook still looks good. That's where you find a potential home run, right? Bitcoin, I think, is a potential home run. Depending on when you bought it, it probably already is, right? So again, that is my position, that I think you should be taking risk, but you need to do it in a calculated way, right? With the rest of your portfolio, you definitely do want to be a little bit on the safer side. But also, again, I think it depends on your definition of safe, because a lot of people, again, the traditional 60% stocks, 40% bonds, well, I don't think that makes sense, right? I don't think that makes sense. Again, just my opinion, but honestly, I don't think I would ever do that. Again, other people, again, you're my opinion, but I don't think I would ever do that. Literally, like, not even when I'm retired, because when you are, you're going to have enough money where you don't really need to do that. When you have a 10% yield on cost on your portfolio, or you can get even more when it comes to selling covered calls and stuff, why would I trade it in for a 5% bond, right? It wouldn't make any sense, right? So again, that's just my opinion. Obviously, do your own research, do your own due diligence. But again, that's just my opinion.